Welcome to Hibiscus Petroleum's Financial Results Webcast. This webcast presents an overview of the results reported as part of the quarterly financial report for the 3-month period ended 30th June 2018 and earlier released today. The 30th of June is also our financial year end, and thus, these results represent our unaudited financial results for the 12-month period from the 1st of July 2017 to the 30th of June 2018. This webcast has been prepared by Hibiscus Petroleum Berhad, i.e. the company, solely for general information purposes only, and shall at all times be heard and or viewed together with the full quarterly report for the same period that is made available or published by the company on its website. This webcast may contain forward-looking statements which are based on current expectations, beliefs, and projections about future events or matters. By listening to and or viewing the webcast, you agree to the limitations and notifications set out in the disclaimer section of this webcast. Our presentation today comprises 5 components. In Part 1, Uday Jayaram, our Vice President Corporate Development, will briefly introduce the company. In Part 2, Deepak Thakur, our UK JV Asset Manager and Group Petroleum Economist, will provide an overview and update on developments at our UK producing asset, the Anasuria cluster. In Part 3, Dr. Pascal Hoss, a co-founder of Hibiscus Petroleum Berhad and CEO of C. Hibiscus Sendirian Berhad, will provide an overview of our North Sabah Malaysian producing asset. Dr. Pascal will also review the operational performance of the asset over the 4th quarter. In Part 4, Yip Chi Yeong, or CY, Vice President of Finance and Group Controller, will present the financial highlights of the company's 4th quarter results. Mark Payton, our Chief Operating Officer, will then conclude our presentation with some of our key messages for this quarter in Part 5. Should you have any queries, you may contact our Investor Relations team via the email address provided at the end of this presentation. I shall now hand over to Uday.
Hello, this is Uday Jayaram, Vice President Corporate Development at Hibiscus Petroleum Berhad. Let me commence this presentation by providing you with a brief introduction to our company. Hibiscus Petroleum was listed on the main market of Bursa Malaysia in July 2011. We listed with the intention of being a pure-play oil and gas exploration and production company. Our vision is to be a respected and valuable, pure-play, independent oil and gas exploration and production company. By 2021, our mission is to secure 100 million barrels of net proven and probable, or 2P, oil reserves and or entitlement from currently held assets or potential new ventures located in areas of our geographic focus. We are also aiming to achieve net oil production of about 20,000 barrels of oil per day. On 27th August 2018, our market capitalization was 1.7 billion ringgit. We have approximately 1.6 billion shares in issue, which are held by more than 12,000 shareholders. In March 2018, we were pleased to reward our shareholders through an issuance of approximately 317 million listed free warrants. These warrants have a 3-year tenor with exercise prices that range between 1 ringgit and 1 ringgit and 12 sen, depending on when they are exercised. All our listed equities are Sharia compliant. Our core management team own the largest single block of shares in the company with a 10.6% holding. Corporate and institutional shareholders approximately hold a combined 49% interest, while retail shareholders provide liquidity with circa 40% ownership. Initially, our activities were more focused towards exploration. Since 2014, however, when US shale-related oil production catalyzed a drop in oil price, we refocused our goals, concentrating the growth of our business by acquiring mature producing assets. Our acquisition of the Anasuria cluster of oil and gas fields in the UK North Sea in this regard is consistent with our goals. This asset has been significant in generating positive cash flow and profit for the company over the past 2 years. Through joint ownership in Anasuria, the company is gaining valuable operating experience in the UK. From Anasuria, we have produced an annual average of approximately 3,000 barrels of oil equivalent per day, net to our company over the financial year ended 30th of June 2018. In addition to Anasuria, on 31st March 2018, we became the operator of the 2011 North Sabah Production Sharing Contract, or PSC. The North Sabah PSC covers 4 producing oil fields located offshore Sabah, Malaysia. Under this PSC, we have a 50% participating interest in the asset. Petronas Charigali, a wholly owned subsidiary of Petronas, the national oil company of Malaysia, is our partner. Our partner holds the remaining 50% non-operated participating interest. For our 50% participating interest in the North Sabah PSC, our estimated entitlement of daily oil production over the period 1st July 2017 to 30th June 2018 was approximately 5,600 barrels of oil per day. Financially, our balance sheet is also strengthening. As of 30th June 2018, our net assets stood at 995 million ringgit and our cash balance stood at 122 million ringgit. We also continue to operate without debt. Our current portfolio, consisting of 1 development, 1 exploration, and 2 producing assets, is spread across 3 continents. In Europe, we jointly operate in the United Kingdom. In Asia, we operate in Malaysia, and in Oceania, we operate in Australia. In the UK, oil and gas interests are held through concession-type agreements with the relevant governmental agency. Through such an agreement, we have a 50% jointly operated interest in the Anasuria cluster. Our interest comprises 4 fields which produce to the Anasuria Floating Production Storage and Offtake Facility, more commonly known as an FPSO. At the Anasuria cluster, our total proven and probable or 2P oil reserves as of 1st July 2018 was independently assessed to be 24.4 million barrels of oil net to our company. In Malaysia, we concluded the acquisition of a 50% interest in the North Sabah Production Sharing Contract, or PSC, at the end of March 2018. A more detailed explanation of the general workings of a PSC has been provided in Part A, Section 1 of the quarterly report issued today. The North Sabah PSC covers interests in 4 producing fields, which together contain gross 2P reserves of 40 million barrels of oil. In Australia, under a concession-type agreement, we have approximately 6.5 million barrels of 2P reserves, located in the Vic L31 West Seahorse development asset. The potential of each of our assets is further underpinned with volumes of oil which have been classified as contingent resources. In the months and years going forward, we intend to gradually convert these contingent resources into proven and probable reserves, thereby further enhancing the value of our asset base. Deepak will now take you through details on the Anasuria cluster in Part 2 of this webcast.
Hello, I am Deepak Thakur. At Hibiscus Petroleum Berhad, I have 2 roles. I am the JV Asset Manager for the Anasuria cluster. In addition, I am also the Group Petroleum Economist. I will now take you through some information on our first producing asset, the Anasuria cluster, which is located offshore the United Kingdom. Our indirect wholly owned subsidiary, Anasuria Hibiscus UK Limited, or AHUK, has been involved in the joint operations of the Anasuria asset for over 2 years. This asset is located about 175 kilometers east of Aberdeen and has been in production since 1996. Based on an independent reserves assessment and the assumptions contained therein, effective 1st July 2018, the estimated remaining economic life of the asset has been extended from 2035 to 2038. Our interest in the Anasuria cluster comprises a 50% direct interest in the Teal, Teal South, Gilmore A and Kite fields. We jointly operate these fields together with our partner Pink Petroleum through a jointly owned legal entity incorporated in the United Kingdom called the Anasuria Operating Company. We generally refer to the Anasuria Operating Company as AOC. The cluster also includes the Cook Field and in this field we have a non-operated 19.3% interest. We also own a 50% direct interest in the Anasuria FPSO. Included as part of the Anasuria cluster are all the installed subsea production infrastructure and the Anasuria FPSO. Taking a closer look at the field layout, the subsea infrastructure underpinning the production of hydrocarbons is quite extensive and spans 25 kilometers from north to south. We utilize the services of Petrofac, a reputable international service provider, in the role of offshore duty holder for the facilities and pipelines, whilst AOC is, since early February this year, the designated operator for the offshore wells. Our joint ownership of the Anasuria FPSO and management of operating cost through a risk-reward type arrangement with Petrofac are key drivers in keeping our unit production cost at competitive levels for this type of facility. Over the past 2 years, it has been the practice for us to conduct at least one offtake of oil in each quarter from Anasuria. In the current quarter, we varied this practice. Instead of arranging for an offtake by 30th of June 2018, we chose to conduct a lift of an oil cargo on the 2nd of July. This was done to ensure safe and smooth running of operations as we were concurrently conducting critical activities on the Gilmo P2 sidetrack that was being drilled on Gilmo field. Whilst we did not carry out an offtake in the current quarter, we have nonetheless successfully lifted twice as of the date of this report, and a total of approximately 524,000 barrels net to the company have been already sold. We believe that the variation in timing of the offtakes has resulted in the normal volumes of oil being sold at a time of strong oil prices. This has established a strong financial foundation for the financial year ending 30th of June 2019. Notwithstanding the fact that no oil was sold from Anasuria in the current quarter, we recorded a higher average daily oil production rate of approximately 3,375 barrels a day when compared to the previous quarters. Together with gas exported, our average daily oil equivalent production rate for the quarter was approximately 3,736 barrels of oil equivalent per day. The average uptime for this quarter was 94%, which is also an improvement from the operational performance achieved in the previous quarter. In summary, operating performance for this quarter has improved significantly when compared to the previous quarter, as there were no major planned or unplanned events which affected production. Over the past few months, our operations team has focused on safely drilling the Gilmo P2 sidetrack well. This project allows us to learn a great deal in terms of undertaking a drilling project in the North Sea. It will also provide us with first-hand geological data on the field that will undoubtedly come in useful in the future. This project, which commenced operations on the 4th of June 2018, is expected to complete in the early part of September this year. In the current quarter, we also approved an investment to undertake the Cook Water Injection project. This project will be implemented by our operating partner in Cook Field, Ithaca Energy, over the course of the 2019 calendar year. Our capital commitment for this project is expected to be approximately 61.6 million ringgit, which is to be funded from internally generated funds. As previously disclosed, the drilling of the Gilmo P2 sidetrack, amongst other projects which have been identified on this slide, have the common objective of taking us towards the average of 5,000 barrels per day net to AHUK by the end of 2020 financial year. On 23rd August 2018, we announced that the estimated 2P reserves of oil and gas in the Anasuria cluster net to the company has been updated upwards to 24.4 million barrels of oil and 17.5 billion standard cubic feet of gas as of 1st July 2018. This update is based on a reserve report issued by Leap Energy Partners Centurion Berhad, or Leap Energy, which was commissioned to undertake an independent evaluation of in-place and recoverable hydrocarbons. The updated 2P reserves represents a net increase of 4.2 million barrels or 20.8% compared to 20.2 million barrels projected by RPS Energy Consultants Limited or RPS Energy as of March 2016. These estimates have taken into account AHUK's production to date from the asset of approximately 2.5 million barrels of oil since we acquired our interest in the Anasuria cluster. Furthermore, the contingent oil resources or 2C oil resources have also increased from 5.6 million barrels to 7.8 million barrels of oil. Leap Energy's assessment was based on actual production data, wells and facilities performance to date, future production enhancement projects identified for the next 5 years, as well as the latest crude oil price forecast. According to Leap Energy, the asset valuation for AHUK's 2P oil reserves at a 10% discount rate is $401 million. I will now hand you over to Pascal to provide a business overview of our recently acquired 50% participating interest in the North Sabah PSC.
Hello, I am Pascal Hoss. I'm a co-founder of Hibiscus Petroleum Berhad. I'm also the CEO of Sea Hibiscus Sendiri in Berhad. Sea Hibiscus Sendiri in Berhad is the holder of the 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract. In October 2016, we announced that Sea Hibiscus Sendiri in Berhad, an indirect, wholly owned subsidiary of Hibiscus Petroleum, had entered into a conditional sale and purchase agreement with Shell. This transaction entailed the acquisition of Shell's entire 50% participating interest in the North Sabah PSC. The SPA also included interest in the joint operating agreement between Shell and Petronas Carigali in relation to the PSC. This transaction provided Hibiscus Petroleum with its first asset in Malaysia and also marked our second deal with Shell internationally. On 31st March 2018, Sea Hibiscus successfully completed this deal and thereby came on title to the PSC. On the same date, we also became a partner and operator under the joint operating agreement. The North Sabah PSC has delivered production since 1979, and our production rights under the PSC continue until 2040. The deal includes the operatorship of 4 producing oil fields offshore Sabah, namely St. Joseph, South Furious, SF30, and Barton, as well as operatorship of the Labuan Crude Oil Terminal and all other equipment and assets related to the PSC. As reported in Petronas' annual review of petroleum resources, the gross proven and probable reserves for this asset is 40 million barrels as of 1st January 2018 through to 2040, which is the end of the tenure of the PSC. Our independent valuation, performed by Risk Operations Private Limited, estimates the asset to hold a further 79 million barrels of contingent resources, also based on 100% interest in the PSC. Consequently, we believe this asset holds a great deal of potential. As resources are channeled towards identified future development opportunities, subject to capex and oil price, we hope that we will be able to unlock the available proven and probable contingent resources. The table on this slide shows the operational performance of the North Sabah asset over 4 quarters. That is from 1st of July 2017 to the 30th of June 2018. Between the 1st of July 2017 and the 31st of March 2018, Shell was operating the North Sabah asset on behalf of Sea Hibiscus. The performance of this asset has been steadily improving in the key area of average daily production rate. Average uptime has been maintained, and whilst operating cost per barrel has fallen, we expect it to increase in the coming quarters as the level of plant maintenance activities ramp up. In the current quarter, we conducted 2 offtakes and sold approximately 623,000 barrels of oil at an average realized oil price, which includes the premium that Labuan crude oil commands over Brent, of $73 per barrel. When examining the trends over a period of the past 4 quarters, it can be observed that 6 offtakes have been made in such a period. I will now pass you on to CY, who will take you through the financials of the group for the quarter.
Hi, I'm CY, Vice President of Finance and Group Controller, and I will take you through the financial highlights for the quarter. As presented by Pascal in Part 3 of this presentation, the group completed its acquisition of a 50% participating interest in the 2011 North Sabah EOR PSC on 31st March 2018. The fair value of the North Sabah asset as at 30th June 2018 has been finalized and reviewed in accordance with the provisions of MFRS 3, accounting for business combinations. The fair values of the identifiable assets and liabilities recognized upon acquisition have been updated to reflect the working capital adjustments and decommissioning provisions. This resulted in a fair value gain, referred to in the quarterly report as a negative goodwill from business combination of 206.2 million ringgit as at 30th June 2018. As a provisional fair value gain of 112.4 million ringgit had been recorded in the preceding quarter, an upward adjustment of 93.8 million ringgit remained outstanding, and this amount was recorded as negative goodwill in the profit or loss statement for the current quarter. Whilst MFRS 3 allows a 1-year period from the completion date for the allocation of the purchase price to be finalized to determine the fair values of acquired identifiable assets and liabilities, we do not expect to make any further adjustment in this area. The current quarter represents the first time that actual North Sabah business performance data under the operatorship of Sea Hibiscus is being reported for detailed analysis. Earnings before interest, tax, depreciation and amortization, or EBITDA, of the North Sabah asset is reported at approximately 177 million ringgit for the current quarter and 266 million ringgit for the financial year ended 30th June 2018. The EBITDA for the current quarter was impacted by an upward adjustment to the fair value gain recognized upon completion of the acquisition of 93.8 million ringgit. Tax associated with North Sabah in the current quarter amounted to approximately 26 million ringgit. First, profit after tax for the North Sabah segment amounted to 221.5 million ringgit. As for the Anasuria segment, we plan for the offtake due in the current quarter to be deferred to the following quarter to enable the conduct of smooth drilling-related operations at the Guillemot P2 well. In the absence of an offtake in the current quarter, the EBITDA attributable to Anasuria was approximately 5.2 million ringgit, mainly attributable to a net unrealized foreign exchange gain. For the current quarter, Anasuria attracted a relatively high tax expense of approximately 15.9 million ringgit. This is mainly due to deferred tax liabilities recognized, which amounted to 12.5 million ringgit, arising largely from drilling-related capital expenditure of 31.3 million ringgit. We wish to emphasize that when there is a period with high investment in capital expenditure in the UK, the deferred tax charge, which is non-cash, will be relatively high. However, UK tax regulations grant us an immediate income tax relief equivalent to the total capital expenditure against taxable income. For the financial year ended 30th June 2018, profit after tax delivered by the Anasuria segment amounted to approximately 34 million ringgit from 3 offtakes. Whilst profits are extremely important, management's focus remains on delivering strong and sustainable EBITDA levels as long-term business continuity is of the highest priority. The group operates 2 producing assets in 2 countries. The tax structure in the oil and gas exploration and production sector for each of these countries differ. In Malaysia, the tax regime under which Malaysian oil and gas activities are governed is the Petroleum Income Tax Act 1967, also known as PITA. The provisions of PITA are applied to net taxable petroleum income at a rate of 38%. In the UK, the total tax rate for AHUK is 40%, which consists of ring-fence corporation tax and a supplementary charge at 30% and 10%, respectively. Any capital expenditure in the UK is fully deductible from both taxes in the same financial year that they have been incurred, leading to a reduced amount of tax payable for that year. Simultaneously, the deferred tax liabilities, which is treated as an expense to the profit or loss account, are recognized in the same financial year. Such deferred tax liabilities are non-cash in nature. To reiterate, in the UK, capital expenditure incurred in a financial year provides the benefit of immediately reducing tax payable within that same financial year. The capital expenditure is also expected to lead to production enhancement in future years. Over the past few quarters, our balance sheet has been gradually strengthening, more so with the introduction of the North Sabah asset as part of the group's overall business portfolio. We have built our total assets to approximately 2 billion ringgit, and shareholders' funds stand at about 1 billion ringgit, representing an increase of 21% and 15%, respectively, from the previous quarter. Year on year, total assets have increased by 50% and shareholders' funds have increased by 34%. In addition, as at 30th June 2018, the group's unrestricted cash is at a healthy 122 million ringgit. This cash balance does not include the proceeds from the second North Sabah crude oil offtake of 95.8 million ringgit that were received on schedule on 24th July 2018. The restricted cash recorded in our results relates to a security for our portion of the estimated cost of decommissioning the facilities of the Anasuria cluster. A total sum of 13.9 million ringgit has been deposited with a UK trustee to support our ongoing obligations in this area. We are required to periodically place monies in a trust, commencing 18 months from the completion date of the Anasuria cluster acquisition until such time that the security has been fully provided for. Whilst the group has remained debt-free, we anticipate that we shall put in place a certain quantum of debt facilities to ensure that production enhancement projects and opportunities we have in hand may be executed smoothly. Subject to being successful in establishing such debt facilities, our intention is to limit borrowings to a conservative level of gearing. Before we wrap up, I would like to pass you to our Chief Operating Officer, Mark Payton, to highlight a few takeaway points.
Hello, I'm Mark Payton. I'm the Chief Operating Officer of the Hibiscus Petroleum Group. I would like to close this presentation with some key messages. Several milestones have been achieved by the Group in this financial year ended 30th of June 2018 or financial year 2018. At the Group level, we are pleased to have delivered a 92% increase in year-on-year profit after taxation. We are now fully focused on delivering results for the forthcoming financial year ending 30th of June 2019 or financial year 2019. Our goal is to deliver 2.7 to 3 million barrels of oil from our two producing assets in financial year 2019. As of the date of this presentation, we've already completed 3 crude oil offtakes in the first quarter of financial year 2019 across both assets, with 2 from Anasuria and 1 from North Sabah. In Anasuria, we have made considerable progress on 2 production enhancement projects, namely the Guillemot P2 sidetrack project and the Cook water injection project. The Guillemot P2 sidetrack project commenced on the 4th of June 2018 and is expected to complete in the early part of September 2018. The Cook water injection project, on the other hand, has been sanctioned and is expected to be executed in 2019. Furthermore, on the 23rd of August 2018, we announced that the company's estimated 2P reserves of oil and gas in the Anasuria cluster had been updated upwards by an independent expert to 24.4 million barrels of oil and 17.5 billion standard cubic feet of gas as of the 1st of July 2018. The same independent expert also assessed the valuation for the Anasuria cluster. The valuation of the uplifted 2P oil reserves is now estimated at $401 million. In North Sabah, we will be focused on a planned maintenance program, which will be executed over the next 2 financial quarters. Technical work is also ongoing to prepare for development projects, which are planned for execution in the 2019 calendar year. The completion of the North Sabah transaction has boosted our net entitlement of production and 2P reserves to within the range of 40 to 50% of our 2021 mission. We anticipate the gap to be closed by developing identified opportunities within the assets that are in our portfolio and also through new ventures on a selective basis. We hope all these events will act as positive value-enhancing triggers for our shareholders.
And that's all we have for this quarterly earnings webcast. Thank you for tuning in.